Good afternoon, everyone. Today is Wednesday, and that means it's time for this week's market update. This week, I have a special guest on the show. His name is Ian Mullen. He is a mortgage loan officer at Caliber Home Loans and was recently promoted to sales manager. Congratulations, Ian. That's super, super excited.
Thank you.
And thank you so much for coming on the Market Update series to chat with us today about interest rates and some other larger economic forecast elements. What do you have for me today?
So what I want to talk about broadly is interest rates, the rate of inflation, and the effect that it's going to have on the housing market for the next year and change. But in order to do that, there are a couple of topics that need to be understood first. So the first thing I'll talk about is this market called the mortgage-backed securities market. And what the mortgage-backed securities market is the ultimate home of just about every mortgage that's written in the United States. So the way that a mortgage file flows basically is you go to your mortgage lender, you obtain a loan, the bank closes the loan, they wrap up the transaction, and then they deliver it to either Fannie Mae, Freddie Mac, or Ginnie Mae. These are these big government-sponsored mortgage corporations. Their job is to take that mortgage, package it up with a lot of similar mortgages into a very, very large financial instrument called a mortgage-backed security. And then they sell this big chunk of mortgages, the mortgage-backed security, off on the secondary market. Typically, the buyers of these mortgage-backed securities are institutional investors and governments, so like China, JP Morgan Chase, things like that. Big, big companies that want what is considered to be a very safe and stable investment that still delivers a relatively high yield compared to the relatively low risk that they're taking on. The way that the supply-demand market around mortgage-backed securities normally works is it's a place for investors to put their money when investors aren't super certain of the long-term outlook of other higher risk investments. So traditionally, when the stock market does poorly, institutional investors take their money out of the stock market in order to protect it, and they put it into the next highest yield safe investment. Often that is a mortgage-backed security. So the stock market performs poorly, mortgage rates or mortgage bond securities look more attractive, and lenders like me get to reduce our rates. So if a lot of people want mortgage-backed securities, we don't have to charge as much in order to write them and sell them off to these institutional investors. Conversely, when the stock market does really well, investors will try to look for buyers for the mortgage-backed securities that they already have in order to free up that capital and get involved in the stock market. So again, traditionally, when the stock market does really well, mortgage rates go up because people don't want mortgage bonds anymore. They don't see it as a good long-term investment. So that's the mortgage-backed securities market. The reason I bring that up is because the mortgage-backed securities market has not been working the way that it's traditionally worked in the past. Ever since April of 2020, there have been very, very few investors in mortgage-backed securities other than the United States Federal Reserve Bank. The reason why is because in March of 2020, COVID hit, the stock market totally tanked. Mm-hmm. And what would normally have happened in that scenario is investors would take their money out of the stock market, put it into the mortgage-backed securities market, which would usually increase demand for those bonds and decrease mortgage rates. What happened instead was investors were so unsure of the long-term financial situation in America that they skipped mortgage-backed securities entirely and went to even safer investments. So what happened was we were in this environment where I think interest rates are probably around 4.5% or 4 to 4.5% leading up to that COVID market crash. And when the investors sold everything out of the stock market and bypassed the mortgage-backed securities market, the Federal Reserve Bank looked at it and they said, we have a stock market that's crashing and investors aren't buying mortgage bonds. Investors need to buy mortgage bonds because if they don't, we have to jack up our mortgage interest rates to make those bonds appealing to those institutional investors. In order to avoid making mortgage lenders jack up interest rates, the Federal Reserve themselves stepped in and started buying those mortgage bonds that typically institutional investors would purchase instead. Mm-hmm. That's interesting because this is not a tool that the Federal Reserve typically uses. They usually play around with short-term interest rates. So when you hear the Fed is meeting about interest rates, they're talking about their short-term overnight funds rate. So they talk about that, and then sometimes they'll get involved in direct stimulus. They don't traditionally buy mortgage bonds. But starting in April of 2020, they bought mortgage bonds at an insane rate significantly more voracious than the market previously was buying them, just in order to keep lenders writing these things, keep the economy moving. They were buying, I think on a low month, like $45 billion a month, and on a high month, I think they tipped over 90 billion. So they're just spending an enormous amount of money buying all these mortgage-backed securities. What's happening right now, that pretty much brings you up to present day. What's happening right now is between the ravenous purchase of these mortgage-backed securities, which is pumping money into the economy, and between both the direct corporation and direct individual stimulus that took place last year and in 2020, there is just way more money in the economy than the Fed would like for there to be. So what has happened is because there's so much more cash in the economy, people are willing to pay more for things than they were 2 years ago. And that's where this rate of inflation comes in. The price of goods is going up because there's more money to pay for them, which inherently devalues the good itself. Inflation is really scary for the Federal Reserve. It's their primary function to control the rate of inflation in this country. And they have only a few tools that they can utilize to do that. The main tool that they use is their overnight funds rate. And that's the rate that, we're recording this on January 26th. The Fed is meeting today to talk about increasing their interest rates and some other monetary policies. What that rate is that they're increasing, or will likely increase as this year goes on, is the cost at which large institutional investors borrow money from the Federal Reserve in order to do other things with it. So like if JP Morgan goes to the Federal Reserve and borrows a bunch of money at 0.5%, they can go turn around and lend that to businesses at 4%, and that action stimulates the economy. The reason why the Fed is now talking about increasing interest rates is because if they increase interest rates, that will increase the cost for corporations to borrow money and lend it back out to other individuals, and it will slow the economy down. So it acts to take money out of the economy that they've been pumping into it for the last 2 years. The other thing that the Federal Reserve has announced they're going to start doing is they're going to begin to curtail the purchase of their mortgage bonds. So basically between April of 2020 and now, the Fed has been buying mortgage bonds at such a rate that it's kept interest rates. I think the average interest rate for a 30-year fixed mortgage last year was like 2.82% or something like that. Crazy low, artificially so, which was great for everyone who got a loan last year. But the Fed is buying less and less of those mortgage bonds, and they're trying to figure out at what point will interest rates be high enough that they can stop buying bonds altogether. At what point will interest rates be high enough that JP Morgan and China want to buy these mortgage bonds again? And we're not there yet. But since the start of December, when they began to curtail these bond purchases, interest rates went from, I want to say 2.875 or so in December up to closer to 3.5. And we're going to see continued curtailment of those bond purchases as this year goes on, while the Fed tries to figure out where equilibrium is. What rates do we need to charge in order to get JP Morgan to buy our bonds so the Fed doesn't have to anymore?
And does that lead to what you were telling me about a couple weeks ago, how normally you get maybe one rate sheet a day, and it was quite a few more than that?
Yeah. So we get rate sheets throughout the day sometimes, but typically first thing in the morning, we have a rate sheet waiting on our desk, and we pretty much know, rates are going to be here or really close to here until close of business. The bond market has been so volatile. Well, institutional investors come in, the Fed decides not to buy bonds on a daily basis, that instead of having that one rate sheet that we get in the morning, I had one day where we had 7 rate sheets in an 8-hour period. Crazy thing is it takes 10 or 15 minutes between shutting down the old rate sheet and starting the new one up. So if you've got 7 changes, that's 2 hours in the day that I was not able to lock loans, which is just an aside. But it's crazy that rates are changing so often that for big chunks of some of these days, we can't lock loans at all. So anyway, it's been extremely volatile. Mortgage rates have not been stable lately. A lot of first-time home buyers, rightfully so, take a long time to purchase homes. It's, you're going from maybe the most expensive thing that you purchased in the past was a car for tens of thousands of dollars, and then you're looking to buy a home in Bellingham for, I don't know what the cheapest home in Bellingham is on the market right now, but it's
Right.
a lot more than
400 something, 500
400
something.
something. Yeah. So you're kind of going 0 to 60 real fast. And it's good
Yeah.
to take that process at whatever pace you need to in order to understand it and be comfortable with it. The downside to that is that a lot of people started shopping for homes with me a year ago when interest rates were 2.75 or in that ballpark. And now that same interest rate is almost a full percentage higher, while home prices have simultaneously gone up. Well, again, Tiffany, you probably know that better than I do.
Yeah,
but
23%.
Yeah, that's crazy. So just
Right.
the net affordability of the market is so much worse now than it was a year ago that it's shell shock to a lot of people, sticker shock.
In terms of an interest rate going up by 1 point, what does that mean for someone's purchasing power generally?
It hurts a lot. If you're borrowing, so my average loan amount was $474,000 last year. So that loan today is $395 a month more expensive than it was 1 point in interest ago. And that's a lot. All other things being equal, that is $80,000 in purchasing power that's gone because of increased interest rates. So what does that mean going forward is really the question. We can't go back and buy a house 6 months ago.
What?
I know, if only.
Welcome to the Cohen Group where we time travel.
That would be quite the service.
The insurance is incredibly expensive.
What that means going forward, though, nobody has a crystal ball, but the Federal Reserve has announced that they will likely continue to curtail the purchase of bonds and increase, increase that short-term borrowing rate. Increasing that short-term borrowing rate is going to hurt the stock market. Hopefully, that's exactly what they're hoping to do with that. As they could curtail bond rates, mortgage rates will have to increase to make those mortgage-backed securities more attractive to institutional investors. So don't hold me to this. The vast majority of experts believe that we'll continue to see rising interest rates over the course of this year, up to and maybe surpassing a 4% average. While simultaneously, real estate prices have certainly begun to plateau, although that's not saying much compared to 20+% appreciation last year. But the Association of Mortgage Bankers thinks that we'll have somewhere between 6 and 9% national real estate value appreciation, with certainly markets like Whatcom County being on the higher end of that scale. So we're in an environment where interest rates still have a lot of room to go up, while home prices are still, while flattening, they're still increasing. So when we look at like clients' net affordability, which is sort of where wages meet home prices, meet interest rates, it's only going up. So my advice to clients, and I don't think I've ever really strongly advised this until maybe a year ago I started doing this, is that if you're going to buy a house, get as serious as you can, as quickly as you can, because the market's getting away from us. And we've had such a long period of economic prosperity that it's hard to imagine them going down, but it just simply must at some point. Whether or not that happens in the next couple of years is anybody's guess. I personally don't think that our area will be impacted significantly, or at least our area's real estate values shouldn't be impacted very much. Could be wrong, but my advice after telling people to get as comfortable as they can with the notion of buying a home that has a payment that you're really not excited about is that at the same time, do not buy a home that you couldn't commit to own for a long period of time if you had to. There are some listings around that clients will look at. It's like, well, you're a family of 5, and this is a 900 square foot house with 2 bedrooms, and I know it's cute, and you think you can do it, but if you had to live here for 10 years, I don't think that's going to go very well for you. So on the one hand, I'm telling people, become equipped to pull the trigger as soon as you can, because when the right place comes up, you should move on it. But in order to qualify as the right place, it needs to be a home that you could handle living in to wait out a recession, or contraction is more likely what I'm expecting, if you had to. Yeah, for buyers, I would say, spend some time with your real estate agent and your lender, really clearly outlining your goals. Find people that you can trust, because this market's moving at a rate where you'll have to make decisions faster than you're comfortable making those decisions. And you need to be able to trust the people who are advising you.
So one of the purposes of these types of conversations is at least getting this kind of data and context and information out in front of people who might be considering a move, or this might be the type of information that tells them, hey, I'm content where I am, whatever my situation is right now, and I
Yeah,
don't want to jump into the fray and even just the emotional ups and downs of this kind of thing. And so I super appreciate you
absolutely.
coming on and giving that context. And then it's data, it's facts, it's reality. I always say that on this show. Like, we don't always like it, but it's reality. And yeah, when you step into big decisions like this, it's best to know what you might be coming up against.
We try to be really good at setting expectations up front. We'll tell clients, this is going to be expensive. There are parts of it that are not going to be fun. But if you go into it with the mindset of, at the end of this process, I will have a payment that I know isn't going to change for as long as or will change very little for as long as I own the home. And as long as you go into it with the mindset that you could live in this home if you had to for a long period of time, then there's only potential upside. If you're prepared for the worst case scenario, which is buying a house and living there for 7 years, I mean, that's not a bad thing.
Yeah.
As long as you go in with that expectation that your worst case scenario is that you could, for a period of time, potentially be stuck with a payment that's higher than you'd hoped for, and a home that you can't sell because the value, if it values dip for some reason, you don't want to move and write a check. As long as you go in with that mindset, either your expectations will be met over the course of your home ownership, or I'm wrong, the economy will continue to thrive and you'll just have appreciating real estate value at an insane rate in a beautiful part of the country. So as long as you go into it with that mindset and you're well educated and well informed of the decisions you're going to make, there's really no way to go wrong.
Thank you so much, Ian. I super appreciate you taking the time to hop in here and explain some of this to our listeners. If people have any questions or would like to follow up with a consultation or just pick your brain on these types of things, how can they best reach you?
Yeah, nothing would please me more. You can reach out to me, cell phone, email, whatever. Love to take you to coffee.